Hi, what's up guys? Welcome back to the Daily Stock Picks. And in this video, we will be going over 4 trend-defining cable stocks that you should consider buying right now, according to this article by Investors Place. So what I'll be doing here for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether these 4 companies either belong in our dividend portfolio or our value portfolio by using this checklist. So if you guys feel like being awesome, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And now, without further ado, let's get this video started. So 4 trend-defying cable stocks to buy now. These companies have the resources and diversification to withstand the pandemic and thrive. By Joel Buckner. This is an article written by Investors Place. Make sure that you check it out on this particular URL as well. So, the conventional view is that cable companies are toast. The rise of on-demand advertisement-free and low-fee streaming services is put an end to traditional TV. Each new streaming service puts another nail in the coffin of cable stocks and further depresses their share price. And the novel CVPD has only served to hasten this seemingly inevitable trend. So I do get what the writer is saying here, because oncoming with Netflix and with the new generation, I believe that technology moves forward. Similarly, cable TV has become a thing of the past. Just remember the boxy cell phones that we used to use back in the early 2000s. Now it's like iPhone, just really slim and stuff. So, but not so fast. To paraphrase Mark Twain's reports of the death of cable are greatly exaggerated. Market analysis by Grandview Research found that, contrary to the popular narrative, the global broadcasting and cable television market continues to grow. This market was valued at $305 billion in 2019, and it is forecast to expand at a compounding annual growth rate of 3.4% between 2020 and 2027. So CAGR is a fancy word of saying that how effective it's growing over the past year over year. So it's around 3.4%, nothing exaggerating. But if the cash flows and if the companies do pay a dividend, we should be considering to look at this as sort of like a retirement portfolio. Okay. So increased competition from streaming services is causing cable companies to ramp up their efforts to capture market share. They are diversifying their services and offering innovative new products. In other words, cable companies are adapting to survive and thrive. With that in mind, here are 4 cable stocks that will survive the pain. So these are the 4 cable stocks that we will be looking at. Now let's get it started, guys. So cable stocks, Comcast, ticker symbol CMCSA. So let us begin with the traditional cable company that is having success with an innovative streaming service. In April, at the height of global pandemic, Comcast launched a new streaming service called Peacock through its NBCU Universal division. Peacock primarily offers NBC programs from the past and present, as well as movies from the Paramount Pictures. However, Peacock is unique in that it does not charge a monthly subscription fee, as its robust ad campaign makes clear consumers can stream content on Peacock for free. That's pretty good. So they're allowing a streaming service for absolutely free. Okay. But how does this work? Comcast makes money on the venture through advertisements, which pop up occasionally like on YouTube. This approach has proven to be a big success, and Comcast reported that as of July, Peacock had signed up 10 million people. The company forecasts that Peacock will have 30 million to 35 million monthly active accounts by 2024. So, the largest cable TV company and the home internet service provider in the US has several other things going for it too. Comcast has been pushing its Xfinity internet service to grade schools and universities as they prepare for the upcoming school year, offering several deals to help grow subscriptions. The company is also super diversified and has its hands in everything, from theme parks to movie studios and even a mobile phone venture. This means that while Comcast is the biggest cable television provider in America, it is not solely dependent on cable for its future. This company that has the resources and diversification needed to continue adapting and weather the current economic storm. So, what the writer is saying is that Comcast, though its major sector is the cable TV division, but it has been well diversified. So the management is thinking outside the box and trying to see how they can increase the revenues for the investors or the owners of the company. So that's pretty good, coming to the point that has been implied in this particular article. So CMCA stock has been recovering nicely in recent months and is up 30% from its March low. Okay, shares are currently trading at $43. The consensus view of analysts is to buy Comcast stock, and there is a median price target of $49 a share. Okay, so they're saying that Comcast is a buy at the moment, and there's a little bit of upside, and analysts are projecting that the company can grow up to $49 per share. So now CMCSA. Now let's have a look at the price to earnings ratio. So the current price to earnings ratio is 17.87, and the S&P 500 index, which is the 500 of the Standards and the Poor's of all the stocks in the stock market. So it is definitely cheaper, nearly 50% cheaper when compared to the broader stock market, right? Now, let's see if this company belongs in our dividend portfolio. I'm just trying to get that slide up. Okay, so in order for a company to belong in my dividend portfolio, it needs to meet 4 rules. The principles behind these 4 rules is based upon these 3 books that I read. First book is Dividends Still Don't Lie by Kelly Wright. The next book is Get Rich with Dividends by Mark Lightenfield, and The Ultimate Dividend Playbook, which is written by Josh Peters, who is an editor at Morningstar. And the 4 principles goes as follows. Rule number 1, the current free cash flows must be positive. What do I mean by this? So free cash flows is the amount of money that the company physically gets in terms of cash after paying out all of its dividends. So if you want to be like sleeping well at night investing into a company, we need to make sure that the free cash flow is positive, right? And rule number 2, the dividends that are being paid out should not be more than 75% of the current free cash flows. So what do I mean by this? So beautiful, wonderful companies like these, they generate so much amount of cash flow that they decide to pay its owners just for holding on to the stock, right? Some companies do this because they are cash cows, and some companies do this because they have gotten into a pseudo agreement with the dividend holders. If they stop paying the dividends, the stock price will fall down, so they're indirectly obligated to start increasing the dividends, right? So the dividends paid out should not be more than 75% of the current free cash flows. What this means is that, let's say that a company is generating $100 as a free cash flow. We want to be making sure that the company is only paying out $75 or less than $75 to the shareholders, because we want to be making sure that the company does hold on to some amount of cash so that the management can either reinvest it back into the business or think of some new creative ideas in order to generate more revenue for the company. And rule number 3 is that consistent dividend growth history of at least 5 years. So great companies that pay out a dividend and are cash cows generally to have a tendency to increase the dividends year over year. The minimum requirement that we're looking for is 5 years, but if you want to be really conservative, I would recommend looking for companies that have 10 years or more. Since I'm looking at all the other aspects as well in terms of the value portfolio, that's why I have a general rule of thumb that I will be going for companies if they are paying 5 years of at least dividends. And rule number 4 is we want to be buying the stock at the correct price or when it's on a sale, right? So whenever the current dividend yield, we'll go on that later, is more than the 5-year average dividend yield, that is the exact time to buy this particular company, meaning that it is conservatively on sale when you compare it to the past 5 years. Now, so CMCA, we've already seen this. It is lesser than the broader market, but now let's go into the fun stuff. So what I actually use is Y charts, because they do a really good representation in a visual manner of the information in the balance sheets and everything like that. Me being a visual person, I like to look at graphs rather than looking at numbers, right? Hope that makes sense. So the revenue for Comcast has been increasing consistently. So it was around $37 billion, and currently 10 years ago, and it's right now somewhere around $108 billion, which is pretty good. And in comparison to the free cash flow that we're talking about, it definitely meets this criteria because it is positive. So free cash flows back in 2010 were around 5.6, let's just say $6 billion. So it nearly doubled one time. So the growth rate would have been somewhere around a 10% year over year, somewhere around that. And we can see that Comcast has been paying out dividends consistently over a couple of years. Let's have a look over the past 10 years for sure. Now, let's see if it meets our criteria, if it's less than 75% of the free cash flows. For this, what we'll be doing is we'll be dividing this by this so that we can get the proportion, right? 3.735 divided by 13.27. So it's only paying out 28% of its free cash flows as dividends, meaning that the remaining I believe 82% of it can be reinvested back into the business. 82%, I think it's 72%, right? Yeah, 72% of the company can be reinvested back into the business, which is pretty good in terms of the free cash flow levels and the amount that it's paying out as dividends. Now let's have a look at the dividend growth history. Now we just need to type in the ticker symbol here, CMCSA, Comcast. So it's currently trading at $44 per share. So we can see that the company has been increasing its dividends, but the growth has only been increasing over the past 3 years. So it's not a consistent increasing of this particular dividend. As a result, since it hasn't been increasing its dividends over the past 5 years, I wouldn't be looking at this stock because there is some inconsistencies in paying out dividends if you are considering for your dividend portfolio here. Now, as a result, since it does not meet this particular criteria, this does not meet our dividend portfolio at all. Now, let's see if it meets our value portfolio criteria or the principles in our value portfolio. In order for that to happen, the 5 principles in my value portfolio are based on these 3 books. The New Buffettology by Mary Buffett and David Clark. I think Mary Buffett is the daughter-in-law of the famous Warren Buffett, the Oracle of Omaha. The next book is Rule Number 1 by Phil Town. A pretty good read. He is a really good writer who interprets the financial information and what to look for in companies. But I'm just taking the quantitative aspect of the analysis for the sake of simplicity of the video. The third book is The Little Book That Still Beats the Market by Joel Greenblatt, which is pretty phenomenal, where he stresses upon the return on invested capital and other ratios for us to find the cheapest stock when compared to the broader market. And the 5 principles are as follows. Rule number 1, the return on invested capital must be greater than or equal to 10. So there, I put a star sign there because if the fundamentals of the company are pretty strong by looking at the other numbers, I will be considering companies which are less than 10%, but they definitely need to be more than 5 or definitely more than 0 per se, right? So return on invested capital is the amount of money that the company is able to generate for every dollar that you invest into the company. Let's say that the company, for a company ABC, you invested $100 into the company, and if the return on invested capital is 10, it means that it's giving out $10 in returns to its owners for every $100 that they're investing. So it's basically the profitability, right? And rule number 2 is that it needs to have consistent net cash flows. As we discussed previously, we don't want to be investing in companies that do not produce a positive cash flows, because there's no point in investing in this company because you wouldn't be speculating, right? The rule number 3 is that the company should have a strong balance sheet. So balance sheet is shows where all the liabilities are, we want to be making sure that the total debt that the company owes to other third parties should be cleared off within a significant amount of time. Generally, rule of thumb will be 6 years or less than 6. We'll go on that later. And rule number 4 and rule number 5 are the buy criteria for the particular company. So I will only be considering to buy this company if either rule number 4 or rule number 5 meets the criteria. So rule number 4 is that if the current price is lesser than equal to 80% of the fair price, which will be calculating the intrinsic value based upon our Google spreadsheet, right? And rule number 5 is that the current price to earnings ratio is less than the 50% of the highest price to earnings ratio over the span of 5 years, and it definitely needs to be cheaper than the S&P 500 index. Okay, since we have that done, we definitely know that this company does not meet the dividend portfolio, but we can definitely see if it meets our value portfolio criteria. Looking at the return on invested capital, not very attractive. We are looking for something which is more than 10%, but 7.05% for a company of this size, it's pretty all right. Not too shabby. So we already analyzed the revenues and the free cash flows. We know that it's well within our positive free cash flows that it's paying out. But the total, when coming to its balance sheet, so the return on invested capital doesn't meet it. Consistent balance sheet cash flows, because we can predict the cash flows. We know that it's going to be somewhere over here or here when 10 years from today, right? Now let's have a see if it meets the balanced portfolio, like the balance sheet. So we can see that there's $104 billion on its balance sheet as total long-term debt that the company owes, and the current cash flows is around $30 billion. So let's just do some simple mathematics. So 100 minus 30 is $70 billion, and $70 billion. And in terms of the free cash flows, if we deduct this by this, we can see that the company is left with around $10 billion each year in order to clear off this long-term debt. So according to my calculations, if you pay it off with the current assets, which are the most liquid assets on the balance sheet, which can be cleared off within a single year or 12 months time frame. So if you deduct this by this, the company will be left with $70 billion in long-term debt, and that can be cleared off within the span of 7 years if it is able to maintain cash flows. As a rule of thumb, I like to look for companies that do pay, that can clear off long-term debt within 6 years or less. But since it's just 7, I would say it is all right for now, but we might need to be looking at the fundamentals here a little bit more if you are going ahead and trying to invest in the company. Now let's calculate the intrinsic value of the company. We can see that the earnings per share trailing 12 months is $2.49. Now we are going to be looking for the price to earnings ratio so that we can multiply this earnings. CMCSA. Okay. The lowest was around 6.243. The highest is 22.39. And let's have a look at what the Wall Street analysts are currently recommending about this stock. I think I did a mistake. CMCSA. So they're expecting that the company should grow around 4.95. So what we're doing here is that we're taking this earnings estimate in the spreadsheet, taking it to 10 years from today, what the earnings estimate might be, and we'll be multiplying with the price to earnings ratio. So a good thumb of rule is that you should be looking at the minimum one. So we can either multiply the earnings estimate, which you'll get around 9.9, or you can take the average of the price to earnings ratio over the past 5 years. As a good rule of thumb rule is that to consider this as to be the minimum one so that we're conservative on our estimates, right? And looking at this, we can see that 10 years from now, the intrinsic value or the stock price of the company would be somewhere around $38 per share, right? And the fair price at which we should be buying the stock, considering a 15% return on investment year over year in the span of this 10 years, is $10.82. We want to be buying this company when the fair price is around this time frame or this price, right? And the margin of safety is basically we never want to be paying out this exact price because we don't know what the vicissitudes or the 10 of the coming future is going to be. So definitely we need to consider a margin of safety for that. So $5.41. But we can look into companies that are trading below around 80% of this fair price. That would be around $8.66. But we know that the Comcast company is currently trading at $44.56, which is already at its intrinsic value if you were considering this growth rate and stuff. But we definitely know it does not meet the price criteria, but we can see if it meets our current earnings, price to earnings ratio criteria. So looking at this, the highest of the price to earnings ratio in the past 5 years is 22. If you consider half of this, it would be somewhere around 11. So if it is below 50% of the highest price to earnings ratio, then we would consider buying this, right? But in this case, the price to earnings ratio is 17.87. As a result, Comcast doesn't meet our criteria in order to belong either in our dividend portfolio or our value portfolio. Not bad, but we want to be looking at more stable companies. Now let's have a look at the second company in this list. So the second company is AT&T, ticker symbol T. AT&T traces its roots back to Alexander Graham Bell and the invention of the telephone in the late 1800s. Over the decades, the company has evolved. Now it is the largest telecommunication firm in the world, and through its ownership of Warner Media, it is also the largest media and an entertainment company in terms of revenue. Thankfully, AT&T is not stuck in the past. It continues to reinvent itself and remain resilient. To be sure, streaming services have hurt AT&T's pay TV business, which has lost 1/5 of its subscribers in the past year. Oof. So around 20% of its subscribers were lost last year because of the streaming services. Okay, so pay platforms such as DirecTV are getting clobbered by services such as Netflix. However, AT&T is not backing down. Since acquiring Warner Media in 2018, AT&T has launched the new HBO Max streaming service. It has also rid itself of redundant services such as HBO Go and Watch TV and hired Hulu's former boss to unify its streaming effort. Plus, AT&T has put a premium on content. Not only does the company control HBO's catalog of popular and award-winning shows, it has also secured the rights to hit shows such as Friends and The Big Bang Theory for its own streaming purposes. AT&T stock looks cheap at its current price of just under $30 per share. Plus, AT&T stock is a dividend aristocrat. The company offers a 7% dividend yield and has increased its dividends every year for more than 25 years. Whoa, that is pretty good. But let's see if the company does meet our dividend criteria based upon the facts and figures that they mentioned here. So let's have a look at the price to earnings multiple. So the price to earnings ratio is 18.34, which is definitely cheaper than when compared to the rest of the market. Now let's have a look at AT&T, ticker symbol T. Very simple, yeah. So AT&T, the revenues have been increasing consistently over the past 10 years. So as the cash flows. So you can say that the free cash flows have nearly doubled. So around 10% growth year over year in terms of its free cash flows. And out of which we can see that the company has been paying out dividends and it's accounting to around $14 billion. Free cash flows must be positive, definitely met the criteria. Dividends not more than 75% of the free cash flows. Let's do the calculation. 14.89 divided by 29.23. So around 50% of the free cash flows is being paid out as dividend. Yeah. So looking at that, So the remaining 50% can be reinvested back into the company by the management so that it can grow its capped stock price, right? Now let's have a look at AT&T's dividend history. They said that it has been growing over 25 years. Let's have a look to see exactly how many years it has been increasing in. Okay, exactly 25 years. It has been increasing it at a rate of 2.21%. I'm not especially happy with the growth rate at which the dividends have been increasing, because I did see some companies which increase more than 10%, right? But nevertheless, it is a good dividend company for you to invest in, and 25 years it has been increasing its dividends, and I don't see any time slowing down because it's only accounting to 50% of the free cash flows, right? Now let's have a look at our buying criteria. So AT&T's dividend yield. So we want to be buying the company when the dividend yield is more than the 5-year average dividend yield. So the current dividend yield is 6.89 and the 5-year average is 5.62. So definitely we would want to be buying the stock because it is at a particular discount when compared to the dividend yield theory. So AT&T, ticker symbol T. Today's date. Now our today's price. Okay. The price for this. I think it's Google Finance formula P. We're looking for the price here. So $30.40, and this should definitely belongs in our dividend portfolio. Okay, now let's say if the company also belongs in our value portfolio, just for fun's sake, right? Minimize this, type in T. So the return on invested capital, not attractive at all. It's 3.79 and it has been fluctuating pretty consistently. So there were a couple of years where it reached above 10, but it could be because of the new carriers that are coming in and taking a hit on the competitive advantage or the mode of the business. We know this definitely doesn't meet the criteria. Consistent net cash flows, definitely. Now let's have a look if it has a strong balance sheet or not. So currently we can see that the company has $168 billion in long-term debt, which it owes to other third parties. If we deduct this, we can say that it's almost $110 billion, right? Despite this 15. Okay. $110 billion minus or divided by 15. So it would take around 7.33 years for it to clear off its total long-term debt. I'm okay with that, and I would say that it does have a pretty good, strong balance sheet. Now let's find out the intrinsic value of the company to see if this company does belong in our value portfolio by using the intrinsic value calculations. So coming to the looks of it, the earnings per share is $1.63 per share, and the price to earnings ratio over the past 5 years is 5.172, 36.77. Ooh-wee, it does seem to be on discount at the moment. Let's have a look, because my trigger got tripped, or like the alert got triggered. So the next price to earnings growth for AT&T in the span of next 5 years is 0.29. Hell no. So the multiplication ratio would be 0.52. So as a result, we can get an exact price based upon the intrinsic value calculation, because the intrinsic value is going to be 0.97 because of the growth is really small. But we definitely know it doesn't meet this rule number 4, but we can definitely see if it meets rule number 5. So the current price to earnings ratio is at least 50% or lesser than this. Coming to the looks of it, 36.77 divided by 2, 18.35. So it's definitely below the 50% of the highest price to earnings ratio over the span of 5 years. So definitely it does also belong in our value portfolio under the rule number 5. So one stock definitely met our criteria in terms of both the dividend and value portfolio. That is I'm pretty happy with that. And it does seem to be at a discount at the moment if you do decide to buy this company at this particular price. Want to be okay. Now let's have a look at the third company. So Charter Communications, ticker symbol CHTR. Charter Communications is a favorite of the legendary investor Warren Buffett, whose Berkshire Hathaway Class A and Class B shares owns CHTR stock. What makes the Connecticut-based company so popular among experienced and successful investors? For starters, it is the second largest cable operator in the United States by subscribers after Comcast. Because of this, it benefits from live sports with MLB, NBA, and NFL games driving subscriptions. Second, Charter benefits from local advertising, which continues to rise. The company announces that net new customers additions grew from 203,000 in a year ago quarter to 753,000 in Q2 of this year. Charter Communications is also seeing an acceleration in profits and free cash flows following the successful integration of Time Warner Cable and Bright House Networks, which it purchased in 2016. So Charter stock rose nearly 14% in July and is up 25% year to date at $610 a share. Analysts expect the stock to reach $650 a share or higher in the coming 12 months and have a buy rating on it. Clearly, Mr. Buffett knows a thing or two about picking good stocks. Okay, let's have a look. CHTR. Ooh, it's definitely expensive when compared to the price to earnings ratio of the entire broader market. But let's have a look and see if it meets our dividend portfolio. Okay. Free cash flows, unlike the revenue, has been increasing consistently. The free cash is $727 million. And it does not pay any dividends, so as a result it doesn't meet our dividend criteria, but we can still see it in terms of a value perspective. The return on invested capital is pretty low, 1.42. And let's have a look at the other. So $727 million. So it did come across a little bit of hiccups here and there. At $25 billion, it just literally bled out. I don't see why that was. Maybe they might have made an acquisition, but I'm not pretty sure about that. But let's have a look at 4.608. The balance sheet isn't that attractive either. It has around $78.37 billion in long-term debt, which can clear it off around $5 billion, so 72. So 72 divided by 4. It will take around 18 years for the company to clear off this long-term debt. As a result, since the balance sheet isn't pretty strong and the return on invested capital isn't strong either, I would be skipping this company. I understand that Warren Buffett has invested in the company, but I am not sure. Like, he's a guy who reads financial statements and everything, but we're just going off by numbers. And looking at the numbers, it does not look attractive at all. Now, let's have a look at the last and final company. It is Dish Network, ticker symbol DISH. Dish Network is a direct broadcast satellite television provider, and the company stock has been on tier in recent months. Dish stock has more than doubled from a March low of $18 a share, while the stock has pulled back to around $34 recently. Many analysts are forecasting that the stock will breach $40 per share in the near term. Dish stock's rise has been due to largely to its diversification into mobile wireless markets. The company completed its acquisition of Mobile Boost on July 1st, which officially marks Dish entries into wireless retail market. Dish is now focused on rolling out an ambitious 5G wireless plan after investing $11 billion to acquire wireless spectrum licenses and related assets. The company says it will cover 70% of the US population with wireless service by mid-2023. Ooh, that's a wild acquisition, but let's see. While Dish is losing TV customers, the company lost 40,000 paid TV subscribers in the second quarter. The pace of cord cutting has slowed, and the move into wireless should help to underpin the TV side of the business going forward. Dish stock currently carries a buy rating from analysts. Okay, so let's just see. DISH. Definitely nearly 50% on a discount when compared to the rest of the broader market. Let's see if the company meets our dividend portfolio. DISH. It did pay out a dividend back in 2011, and it doesn't pay out a dividend at all right now, so I wouldn't be looking at this as a dividend portfolio. Now let's see if it meets our value criteria in order to see if it belongs a spot in our value portfolio. So the return on invested capital was pretty good back in 2010. It was around 20% or so, right? Now its return on invested capital is 5.66. Not that attractive, but we can let that one pass. It's generating around $12 billion in free cash flows. So it's basically like a bell curve. The free cash flow, the revenues haven't increased at all, and the free cash flows are almost the same. So nearly 0% growth over the past 10 years if you were looking at the free cash flows perspective. And the total assets is $4 billion. So we can't say it's particularly consistent, but we can see that it hasn't moved anywhere. But in terms of the balance sheet, so it will be left around with $9 billion, which it should be cleared off within 9 years if it chooses to do so with its free cash flows. So as a result, since the substantial amount of time is pretty large and the return on invested capital isn't good, and I wouldn't be even considering the stock in terms to belong in our value portfolio because of the fundamentals doesn't seem to be pretty strong here. Now, Joel Bagwell has been an business journalist for 20 years. He spent 5 years as a staff reporter at the Wall Street Journal and has also written for the Washington Post and Toronto Star newspapers, as well as financial websites such as the Monthly Fool and Investopedia. As of this writing, Joel Bagwell owned Berkshire Class B shares. Okay, so generally the writers generally disclose what stocks that they're owning, just so that they're not trying to boost up the stock or anything like that. But here it goes. So out of all of these 4 companies, the companies that I felt definitely belonged in our portfolio in terms of like a quantitative analysis perspective is AT&T. It belongs in our dividend portfolio and our value portfolio. So it's currently trading at $30.04 a share, which is definitely a buy, and it has been increasing its dividends over the past I would say 25 years or so at a rate of around 2%, if I'm not wrong, based on what I can recollect. So full disclosure guys, this video is for education and your entertainment purposes only. There is no guarantee that you'll earn any money using the techniques and the ideas mentioned in this video. This is not a financial advice. Please consult your financial or tax professional prior to making any investment in these companies. So if you guys have stuck around till the end of the video, I really appreciate it. Make sure that you smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post new videos. Until next time, catch you in the next video. Peace.